Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Ice raw sugar in New York. The main pattern here since September 2024, so coming up now for a year and a half, has been, though I'm now starting to look at another pattern, has been, despite being breached and repaired, the dark blue September to December 2024 bear channel, currently 866 to 1379, which developed into a descending expanding wedge pattern. We are at this time, once again, just over the top of the dark blue upper trend line. Now for most of January and February we have been resting on top of this dark blue upper trend line. We might now be trying once again to push up from it. The last 2 weeks have seen the market mixing in amongst some congestion between, as I said 14 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. End of quote. This latest move higher is tentative, as above. We have the old rectangle pattern. Above this we have the old rectangle pattern from between mid-November last year through to early February this year. We also have late last week pushed up once again over the bright green middle time, currently at 1406. The other main pattern that I think may be taking over from the bear channel stroke descending wedge pattern. That's the bright green late September 24 to late February 25 bearish shift pitch walk. Further above we have the green short medium moving average, which is currently at 1465, right now tied in with the March 21 low at 1466. And then the more interesting mauve medium moving average, currently at 1495. Below the market, well, below we have some support at congestion dating from the early 2020s in the 1248 area, zone, and a gap between 1336 down to 1320 dating from September 2020. So a lot depends on that congestion support between 1379 to 1409. There is a second pattern at work here, and possibly the more important one, though you wouldn't have guessed it so far from its behavior in October and November last year, is a larger bearish pattern and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitch walk. On this one we are a little above the bright red middle time, which is currently at 1338. Now going back to the previously mentioned rectangle pattern between mid-November 25 to early February 26, and by the numbers, between about 1440 to 1535. 3 weeks ago, I said on this, and I quote, "We are below this right now, but if the congestion below holds and we see prices rise back up, then this pattern will have repaired itself. If it doesn't, then I will have to start looking at potentials below of a primary potential in the 1389 zone and a secondary hard to reach potential down in the 1345 zone, just above that previously mentioned gap." End of quote. Since that time we have developed a move lower from the rectangle pattern, reaching the primary target last week, but seemingly failing to extend down to the secondary target X. Given what has happened since, I think the primary target may have been enough, and I'm of a mind to retire target X by the next time we meet. Ice Europe white sugar in London. After all this time, there still continues to be 3 features to this market to keep bearing in mind on my daily chart. The first of the 3 features is the obvious broken, repaired, broken again, repaired, and lately broken, repaired, twisted and bent out of shape purple late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 399 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary back in January 2025 and had since then been severely tested on the top side. Enough that I would not classify it as a descending wedge pattern after February 2025, though it continues to still keep an eye on the extension to the purple upper trend line. As it is, bar some congestion at 425.5 and a November 25 low at 406.40, the nearest support stroke resistance to this market. Next, I also asked you 43 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch hawk. This is a very shallow pitch hawk, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then the market initially started utilizing the bright pink middle tine of this bearish shift pitch hawk, which is currently at 437.40, as an attractor, riding prices lower in a shallow glide, until early October last year, when it commenced a steeper journey lower, such that in early November last year, the market had been closer to the pink lower time for a while, and that's currently at 379.10. However, we saw a pullback upwards mid-November last year, with the market using the congestion at 425.5 as a seeming attractor. That all stopped 4 weeks ago as prices fell, accelerating into a pipe bottom late 2 weeks ago, and then into a V bottom, with last week and this week so far being the shelf, the extension to the V bottom. It really was good to see how the lower pink tine, along with the congestion at 378.20, dating from 2020, halted the fall and turned prices back up again. Indeed, last week's shelf construction could now possibly be seen as a nascent bullish halfway hesitation, or bull flag, possibly with potential up to the 435 area. There's also a third, more recent feature, and this had been true for New York Sugar as well as to London. It's the formation of a rectangle pattern over recent months, roughly between 415 to just under 435. 3 weeks ago, prices broke well below this pattern, and as I said at the time, and I quote, is appropriate to lay out some targets below. Thus, the primary target at 404.20 has been achieved last Friday, so that's actually 4 Fridays ago. And we have a secondary harder to reach target X down at 395 even. This is not an ambitious target, but it nevertheless is still there. End of quote. 2 weeks ago, prices easily achieved the secondary target X, leaving a congestion area overhead between 415 to 435 that will likely be hard to navigate. So please bear in mind, as the top of any possible halfway bullish congestion hesitation come bull flag is actually the top of that congestion area. Sugar white premium spread. What can I say about this market? At the least, it has been a very disappointing one. Disappointing not because the market doing the opposite of what I thought the markets might indicate, but because the market did nothing, or at least nothing much, for quite a while. 23 weeks ago I said, and I quote, things seem to be trying to resolve themselves into a pattern. End of quote. And over the intervening weeks, they seem to be making a possible, if very large, diamond pattern. That possibility looked real until the market dropped down and below what I thought would be the lower bullish trend line. The market not only dropped below this trend line, and let's be honest, it's an unjustified trend line, but went on further to drop and close below the gold long moving average, currently 107.75, stabilizing further down, dropping and closing below a new support line, which is the bright red neckline, currently 97.75, of a new similar pattern, which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October 2025 head and shoulders top. The issue I had and still have with this pattern is that we are well past the early stages, and though we have seen prices lower, significantly lower, we have not confirmed the move lower. You see, 19 weeks ago I laid out some potentials below for such a head and shoulders top pattern, just in case. A primary target X is down in the 70 even zone, and a harder to reach secondary target X1 is down at 43.75. We have come close to the primary target X with a low of 71.25. I suppose some would say that was close enough, but I still kept the target there. However, the gapping action higher seen 2 weeks ago, specifically over the bright red neckline, I am on the verge of retiring these targets below. It's only that prices closed last week on the medium moving average, which is par 50, 100 point and a half, and the high has not exceeded the gold long moving average, currently at 107 and 3/4, has stayed my hand in taking them down this week. What the market does with these two moving averages in the next few weeks will, I believe, determine the future. It was, as I said 19 weeks ago, when I said, and I quote, only concerted, consistent and long-term moves over the new bright red neckline, ideally over the slowly rising long moving average, could possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion. End of quote. We had in recent times been half there and half not there, and the moves over the last 15 weeks exemplified these half in, half out courses of actions. It had looked like indecision, but on a much, much larger scale, more than just a weekly chart can really show. But maybe, just maybe, that is all finishing. One final point, and it may turn out to be a very valid point going forward. We are set up now with just a week left of February to go to have a monthly key reversal here. Thus, if on Friday, the 27th of February, have a close either over 97 or under 90 even, then we'd be on. Anything in between and it would be a lesser outside month. Right now we're looking at a monthly key reversal up.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.